Hi, it's John. Thanks for joining me again here at FinTech Plus. I'm very excited today to be joined by two people who are doing something interesting in the United States that I think we should all be paying attention to. It's called the EBA Fund, and I'm pleased to be joined today by Joyce Klein and Jonathan, I hope I'm getting this right, Brereton. How are you guys doing?
Well, thank you. Good morning for us.
Yes.
Good afternoon from Zurich. Joyce, EBA is something a bit new, and there's a lot of moving parts that have come together to make this happen. But before we dive into all of that, I was hoping we could quickly just get through some personal introductions. Could you start things off?
Thanks for having us with you today. Joyce Klein. I'm the chair of the EBA Fund, or it's also full name is the Entrepreneur-Backed Assets Fund. It's a new fund that we created essentially in April of last year. My day job is that I lead something called the Business Ownership Initiative at the Aspen Institute. And the work of that initiative is really focused on expanding the role that business ownership plays in creating economic opportunity in the U.S. So we work with organizations that are sort of the equivalent of microfinance institutions in the U.S., trying to get capital and other resources to business owners or would-be business owners that have the greatest difficulties in accessing capital and support for their businesses.
Thanks for that introduction, Joyce. And Jonathan, you play an important role with EBA Fund. Can you give us a bit of an intro to yourself and your background?
Absolutely. And as Joyce said, thank you very much for having us. I've spent 20 years in the CDFI sector, so the Community Development Financial Institution sector. 17 years of that in Chicago, working with an Axion affiliate there. And then the last 3 years I've been in North Carolina. I moved down here with my wife and started a new CDFI here called Thread Capital. And also am a principal in Revolve Asset Management, which is the fund manager for EBA Fund. Grew up in a family of entrepreneurs, and I was the bleeding heart in the family. Learned about microfinance in school, and was really excited to put the kind of entrepreneurial passions of our family and my background into helping other people start businesses. People that have been traditionally disadvantaged have a fraction of the resources of people that come from a background like mine. And have been very fortunate to be able to do that work in a variety of different contexts.
It's really interesting to hear about that background, Jonathan, and as well, Joyce. I first came across the idea of microfinance around the time I was lucky enough to go to Oxford, which is unique in having a social entrepreneurship and investing focus in its MBA program. And what I found really interesting about the story about EBA funds is how this really bottom-up innovation about supporting the bottom of the pyramid when it comes to access to financial services and empowering entrepreneurship is coming back to the developed world and showing its potential here as well. That's something I was familiar with, but not everybody's familiar with the context behind why EBA Fund was created. Can you tell us a little bit more about that? And maybe, Joyce, you can get started on that one?
Yes, certainly. So as I mentioned, the work that I do really focuses on microfinance institutions and other organizations that work with sort of the smallest businesses, microenterprises, and very small employer firms in the U.S. And just as a little institutional context in terms of how things look in the U.S., we have a set of organizations here that are called Community Development Financial Institutions, or CDFIs. They're essentially sort of certified by the Treasury Department in the U.S., and they're financial institutions, but their primary mission is to do community development work. And they do a range of different kinds of lending. Some of them do micro-lending or microfinance, and those are the organizations that we've worked with for many years and really tried as a sort of a national organization in the U.S. to try to help them grow and scale their impact. And one of the things we do is we facilitate a group of 6 of the largest microlenders in the United States called the Microfinance Impact Collaborative. And we basically we've been working with them to try to figure out how can they best scale their lending. And we realized that the biggest issue that they faced was sort of the underlying economics of the loans they were trying to do, which is that they were too small to really make a profit. So it's really hard to grow a business when you're delivering a product that's not profitable. And at the time, Jonathan, when we first heard of a story, sort of a strategy that Jonathan was using when he was leading the work at Axion in Chicago, As he left to start Revolve, the whole idea was that he would try to replicate a strategy that he used there, which was to try to basically create liquidity by selling the microloans that they were originating to certain kinds of buyers. We would try to replicate that with other microfinance institutions in the U.S., some of whom were part of the collaborative that we work with, as well as other organizations. So that's sort of the context. It is really a bottoms-up strategy designed by folks who are trying to scale this kind of lending and realizing some real financial constraints in doing so.
It's interesting in the innovation world, especially all the way up here in Switzerland and the luxurious atmosphere of banking innovation, the idea of pain points means something a little bit different. But I find it interesting to look at how real pain points and seemingly impossible problems have been the source of what you're innovating here with the EBA Fund. And Jonathan, I think that's probably a good chance for those who are interested in the financial mechanisms of what's going on and a little bit of the connection to the FinTech world. Can you say more about what it was that you were innovating to connect these pieces and build on what Joyce was saying?
Yeah, so the CDFI sector here in the U.S., specifically the micro-lending sector, has traditionally been its financial structure was relatively simple. They would borrow funds often from commercial banks at below market rates and turn around and lend those funds onto small business owners. Primarily entrepreneurs in low-income communities, people of color, women, etc. But as Joyce was saying, those loans were originated at a loss ultimately because they did not want to charge to the entrepreneurs the cost of the actual cost of delivering those loans. So as a result, one quick point there: the reason they didn't want to do that is because their objective was a community development. They're trying to produce strong businesses in these communities and ensure that they're not taking revenue away from that business desperately needs. So borrow funds from commercial banks, turn around and lend those on to the entrepreneurs, do it at a loss. They then have to go raise operating subsidy to subsidize that business. So in order to scale this business, a CDFI has to be good at both running a lending business and good at fundraising. And if they're not good at both of those things, they're not going to be able to scale it. And even if they are good at both of those things, at a certain point, they bump into a ceiling, just because the model becomes very difficult to continue to raise capital for. So what the innovation that we, I'll be frank, stumbled into in Chicago was innovative for our sector, not necessarily innovative for the rest of the financial sector. Certainly FinTech has done a lot of things very similar. But we sold the loans that we originated. We sold about half of the loans onto banks that needed CRA lending test credit. The loans that we were originating were especially valuable to the bank because they were in low-income census tracts. They were in markets where banks struggle to disperse loans. And given the regulatory requirements of the Community Reinvestment Act, those loans had a value to the bank that was higher than the value they had to the CDFI. So we sold the loans that we originated, sold them at a premium, which reduced our need to borrow, reduced our worry about equity in the fund or net assets in the nonprofit vernacular here in the U.S., and reduced our need to raise operating subsidies.
So there's a lot of things going on there that were really required to make it happen. I guess to summarize, if you were to talk about what it's taken to get EBA to this point, you talked about fundraising and then deploying the capital into these types of facilities. What have really been, as I say, the big challenges, but also the big keys to the success in getting it this far?
So I think one of the big challenges is just it is an innovative idea. Like secondary markets are not that innovative, but it was certainly innovative for microfinance institutions in the U.S. to think about whether they should be selling their loans and at what price point they might be able to sell those loans. So there's a piece about changing minds about this strategy and some of the institutional change that's needed to do that. And I think the other thing that's been interesting is it's been a little hard to get the funders and investors, even though many of them are banks and financial institutions that know what a secondary market is and know what the value is, to think about it in the context of a microfinance institution. So, and then a lot of the really interesting, I think, design work that the Revolve team in particular brought to this was really thinking about where along the lines of these transactions that we're trying to do with banks, with CDFIs and with banks, could a fund structure really build in a lot of efficiencies into making the market work? So how do we streamline the legal part of the transaction? How do we streamline the kinds of data that need to go back and forth? In terms of the servicing and the data collection process, how do we start to integrate different kinds of risk rating systems into understanding how we price the loans? There was a lot of that kind of work that needed to be done that I think the Revolve team has done a really great job of. Jonathan, what would you add there?
Yeah, I think the point that we're fundamentally changing how this industry operates can't be overstated. And there are that just takes time. So that's been at times a real slog. And putting together the structure, thinking through some of the points that Joyce was just making about risk management, and both from a loan risk standpoint, but also operating risk standpoint, the financial structure for EBA Fund, all of those things were frankly fun and interesting to tackle. I think the thing that has been more difficult, and it's just taken time, is we're trying to change the industry. And we're coming at it from a different angle, and there's a lot of there's 30 years of vested interests in how the industry is structured. So interestingly, some of a fair bit of the capital that we've raised to launch EBA Fund came from new funders to the sector and people that were interested in the innovation of it. Yeah, I think it's the structuring is fun, but kind of working through that change process is less fun at times.
I think many in our audience would be familiar with that type of struggle. It's rewarding, but it also comes with its challenges. I'm glad you mentioned who's been funding EBA, or at least alluded to it, because you talked a little bit before about some very traditional impact investing types of organizations that people are probably familiar with, and also alluded to more traditional financial institutions and asset managers getting involved as well. When you look at the aims of the fund, and then also the types of investors it's attracting, can you talk a bit about the evolution from this being something that looks a little bit more like charity to something that looks a lot more like a financial opportunity?
Ultimately, our objective here is to make small business loans more cost effective, specifically in low income communities with entrepreneurs of color and women. And we're doing that with the belief that if we can change the economics, the existing CDFI lenders can grow faster, and potentially we bring new lenders into the market. So capital gets dispersed faster, revolves quickly through this model. I think the secondary objective is to do it in a sustainable way. We did not want to just be another vehicle that was going to require long-term subsidy. So we wanted to build a vehicle that would be sustainable on its own. So we need to raise capital to get it launched like any other business, but the business, once it's launched, will be sustainable.
And Joyce, did you want to add to that?
Yeah, just in terms of thinking of some of the investors and who the investors are and what their motivations are. I think one of the challenges in thinking about the role of impact investing in inclusive FinTech is the question of what kinds of returns people are looking for. This issue that in low-income communities, people who want financial services, whether it's loans or whether it's savings account or whether it's remittances, they're doing small dollar transactions. And small dollar transactions, if you charge affordable rates and fees and use the right kinds of practices, are either unprofitable or marginally profitable. And that means the institutions that build them can't pay in many cases have a really difficult time paying market returns. And so you're really looking at impact investors who are not looking for a market return, or in even cases sort of near market return, you're looking for ones that are willing to take pretty below market returns. In the US, what's been interesting is that sort of the combination of concerns about the pandemic, but a lot of the racial reckoning that's happened in the United States that's affecting our economy right now, where we're noticing how deeply excluded, in particular, Black and brown people in the US are from access to the economy and from access to financial markets. A lot of companies are coming in and thinking about how they use money in their treasuries, where they may have a lot of cash sitting around and they're not earning high returns on it, given what the interest rate context is, how they deploy that. So we're seeing a lot of investment in community development financial institutions in the US from companies that are willing to make investments, make debt available at very low interest rates. And then certainly that's sort of the nexus in many ways of our partnership with Microsoft, but you're seeing that across many large companies in the US, particularly tech companies that, again, have done fairly well in the pandemic, have a lot of cash right now, and are thinking about how they deploy it from a more impactful perspective.
Those are some fantastic points that you've pulled together there, Joyce. So thank you for raising those. And you mentioned also that the Bill and Melinda Gates Foundation has been instrumental in helping to make that happen. And I think that's a great example of the type of systematic leadership that we see coming in to help make this happen, and then bring other people in to support it once it's been proven. So that's really excellent. I wondered, we talked for a moment there about raising the funds and how that's been coming along. And we talked earlier a little bit about how many of the aspects of this have in some ways come from the developing world, where microfinance was deployed for many years and has proven its impact. When we look at the fintech world, I've talked a lot in Switzerland about how we're at the top of the pyramid here, and we're not facing the same sort of pressure to solve those small dollar problems that you talked about. I wondered, when it comes to how you manage the loan portfolio and manage the business of asset management in your book, are there any cases where you've seen examples from the developing world or just from the low income world in the US where that has been a source of innovation or inspiration for what you see developing?
Yeah, so I'll leave the international context to Joyce. I think she's got a better handle on that. But specifically here, the CDFIs we're working with have been in this market for 30 years, have been originating loans in these markets, have thousands of loans on their books today, and have been through several cycles. So have been through downturns before. That's one of the things we saw in the FinTech, the lending sector specifically here in the US, is that a lot of the big lenders launched after the last recession, after the Great Recession, and hadn't been through a downturn yet. The CDFIs we're working with have been through several downturns, have historical records, and a strong capacity to measure risk in their portfolios. Having the Revolve team spent 20 years in this sector, so also has a pretty good handle, we think, on, knock on wood, on the underlying credit risk in the portfolio, and have a variety of ways that we slice and dice it to manage it. One of the key points of our work, we're buying participations in these loans. The CDFIs themselves continue to service them. So the entrepreneur who received the loan in the first place continues to work with the same CDFI, continues to have the same relationships. And we think that's a really important part of this, what we're doing.
Thanks for those insights, Jonathan. And Joyce, did you want to add anything?
Yeah, I think I'll talk maybe a little bit about the role that we see of fintech and technology playing in sort of reaching what people call the bottom of the pyramid, or reaching the most disadvantaged. So I think we've seen a lot of innovation in the role that technology can play in helping organizations to scale and helping them, microfinance. And in some cases, these are for-profit. In some cases, these are nonprofit. In some cases, they're partnerships between nonprofits and for-profit providers, whether those are telecom companies or payments companies or other kinds of companies. I'd say a couple of things. I would say that while fintech has the potential to reduce the costs of some of these transactions, in many cases, it doesn't get them to the point where they are profitable or where they are sufficiently profitable for a lot of for-profit companies, particularly those that may be venture-backed and paying fairly high a cost of capital themselves to really build a whole business around it. And so there continues to be, to reach the most disadvantaged, you continue to need subsidy in the market, I think is a really important thing to understand. You need it in part because sometimes it's just not profitable to scale without having some ongoing subsidy for the transactions itself. The other thing that I would say is when you're talking about nonprofits trying to integrate technology, the way they are capitalized and funded often means that they don't have the financial capability to do what it takes to deploy technology really well. It's not just a case of buying the technology. You need people, you need to change processes. And often funders who fund technology implementation in nonprofits don't really understand what the full cost it takes to sort of implement and manage technology. So many NGOs that are trying to use technology are doing it in ways that they're very thinly capitalized, and it's not as efficient and not as effective as it could be to really realize the promise of that. The final point that I'd make about inclusion is that there's a line between often that you have to balance between opening access and opening access with products that in the end are benefiting the business, not undermining the business. And so one of the things we've seen in some cases is as we've seen access open, you see issues with what kinds of interest rates and fees are being charged, whether people are given actually too much debt, what collections practices are. So often opening up financial inclusion, I think both in globally, but certainly here in the US, our work to try to think about how we scale microfinance, with the role that technology plays, both for-profits and nonprofit, entities, needs to be balanced with a focus on consumer protection or borrower protection for small business borrowers, so that we're ensuring that the products that are made available are really, in the end, really benefiting that business owner and their family and are not, in fact, sort of extracting wealth from them.
A number of great points there, Joyce. Regulation is something that can't be forgotten at all as FinTech is developing. We see that at a high level with technology and financial industries converging in things like crypto. And then, of course, there's a long history of not the most serving of offers at the lower end in small business and disadvantaged communities. I don't want to dwell on that too much. I think we've given people a lot of food for thought here today. I did want to ask, for me, a lot of these ideas we're talking about are ones that, conceptually make a lot of sense, and it's sometimes confusing for people why these things don't take off sooner than they have. But in recent months, and certainly over the last year, as you were alluding to earlier, there's been a lot of social change, and ultimately some political change tends to help these things. What have you seen since the new administration in the U.S. in terms of the momentum gathering around the concept of microfinance and supporting a more diverse entrepreneurial base in the economy?
I think we've seen a lot of positive change. The Biden administration, I think, has a very strong commitment to this issue. We've seen a lot of engagement with them, thinking about, for example, our main relief program for small businesses in the US is something called the Paycheck Protection Program, or the PPP. When it first rolled out, there were a lot of issues that it was not reaching the most impacted small businesses, certainly the very smallest businesses, because it was largely run through banks, which don't have relationships with these with these very small businesses. The financial incentives weren't right. There's been a lot of attention to how to change that program, how to help it reach deeper into communities and to businesses that it wasn't reaching before. There's also some funds in the new stimulus bill, a lot of grant funding for CDFIs that can helpfully provide some of that sort of enterprise level capital that can allow folks to reach more people, to implement technology, to sort of build their organizational strength so that they can be there in communities and reach more folks. There's a lot of people moving into roles in the administration who really understand the kinds of institutions that we working with, the challenges in reaching the most disadvantaged. So I think those are all really positive signs. There's also been a lot of engagement at the state and local level in the US as well to try to address some of these issues.
And Jonathan, do you have investors from outside of the US, or are they exclusively in the US?
No, they've been exclusively in the US.
Okay. Yeah, just curious because, of course, we have a lot of similar interests from international organizations here in Switzerland and abroad. Um, we, as I say, have covered quite a lot of ground. And before we wrap up with a little bit more information about the fund, I was curious, you work in a very stressful, innovative environment. I was curious at where does the team at EBA Fund, first of all, find its inspiration for its work? But also, how do you stay balanced in all the challenges you face and the long term that it can take to get things done?
I mean, we're lucky. We have an incredible team between the team at EBA Fund and the board. We're really lucky. It's a group of really smart people, really engaged people, really nice and fun people. So that makes it easy. And in many ways, EBA Fund has been my inspiration over this past year or almost, of the pandemic and what's happening in the US. It feels like we're building something that's a solution to what we're seeing happening, and we're building it with a really good set of folks. So for me, that's been an inspiration and helped carry me through this period.
And a similar story for you, Jonathan?
My day job has been running a CDFI in the middle of a pandemic. So I've put in a lot more hours. I've never worked so hard in my life. Let's put it that way. But I think for me, yes, everything Joyce said is true. I'm having fun. This is interesting. Trying to basically change something that has been broken, has been effective at helping people, but not enough people. And we haven't seen enough change in our sector in the 20 years that I've been at it. So it is exciting to feel like we've got something here that can create fundamental systemic change in our sector. That's exciting.
That's great. And again, congratulations on all the progress and all the hard work. I'm glad to hear it's been so rewarding. Joyce and Jonathan, as we wrap things up, I was curious if you have any sort of final messages to leave with our audience here at FinTech Plus, especially those who might be interested in either learning more or getting involved with the fund.
Yeah. I think my final message would be more sort of almost a global issue for folks who are interested in FinTech, but also thinking about how you use it to solve this issue of financial inclusion, which is that I think FinTech has a ton of promise to try to help include folks who haven't been included. I think it's often harder than we think it is to actually implement technology, and it's particularly challenging for nonprofits that don't have the right mix of capital to be able to integrate it. So being really thoughtful for funders and investors in this space who want to use it to help the most disadvantaged about what kind of money they actually really need and what kind of support they need to actually make that work is one message. And then the other message is that there really needs to be this balance between opening access and protecting people from products that are harmful in the long run.
Very wise words. Thank you, Joyce. Jonathan, anything you'd like to add there?
Just one quick point to follow up on what Joyce was making earlier. The EBA Fund, we've got a good team. We've got good funding partners. We're having a lot of fun, but we also, in the old, it takes a village. This is not something that 5 people or 10 people or 15 people can ultimately execute and scale. So we're absolutely looking for people that are interested in what we're doing, that have unique skill sets, capital, et cetera, that they're interested in getting involved. So we would welcome people reaching out that have an interest in learning more.
Great. Well, we'll make sure to share much more information about what EBA is doing and how to get in touch with the team. Thank you again, Joyce and Jonathan. Looking forward to getting updates in the coming years as things develop further. So good luck with the continued success of your mission. Thanks again.
Thank you. And thanks for inviting us to be with you.
Great pleasure. All the best. Take care.